Okay, let's narrate this a little bit while we're waiting for it to play out. So let's follow this leg here, okay? So we have a move up, push down, move up, push down, move up, and then a break of this structure as well as this structure right here. So the displacement is qualified here, okay? The break of structure happens here and here. And in this case comes all the way down here. So we're looking for, in this scenario, of course, the fair value gap which occurs on the move down. So in this case, we have this fair value gap. And I mean, in fact, really, we have a fair value gap up here. We have a fair value gap here between these two candles. And additionally, we have a fair value gap right here in between this low and this candle's high. And so you can see it looks like the market actually already played off of this fair value gap right here and gave us this really nice move to the downside. So what we're looking for, though, is we're looking for a pullback up to this imbalance, this fair value gap right here. And I ran the fib extension level, and I like to get in right in between the 62 and 78% level. So I like to go smack dab right in the middle of that. We have our stop loss 2 points above this swing high right here, and whatever exact stop placement I'm looking for, I'll always go 1 tick above that. So we're 2 points plus 1 tick, so 2 points and a tick, okay, above this swing right here. And so again, this entry would represent getting inside of this fair value gap right here between 62 and 78% pullback level. So it's just smack dab in the middle of those two. So we're looking for a pullback to this level right here. Doesn't mean that it's going to smack this exactly and then come down. Of course, that, you know, perfect scenarios just, they don't really exist, okay, in the marketplace like that. But that's what we're looking for, is a pullback here. So if we were doing a live trade, we could essentially have a limit order simply set right at this level, and once it gets hit, we could either have it set up for a bracket order, which would trigger the stop loss to be set there, or we could manually place it there, okay? So and this is such a good move. It's like, man, you could have even taken this move, you know, back up here. But anyway, let's not get distracted. So we're looking for a pullback here, and then we're looking for it to retrace all the way back down to the low, the swing low that it created, okay? So let's just give it time to let it play out and see how it looks. So also, I think a good question would be, well, why wouldn't we just wait for it to return perhaps to this fair value gap and take it here? So my answer would be this. Personally, I know a lot of people don't like indicators, but the way that I would decide between this fair value gap and this fair value gap, if I was indecisive, is personally, I would be looking for the stochastic and the RSI to hit extreme levels. So I would look for them to become overbought, and then I would be looking for signs of exhaustion. So if I wanted to get in here, I would say, are we overbought and do we look exhausted? And I would say that this wouldn't be a bad level, just because we've got the moving average. We have the white line represents the the 50 moving average. The yellow line across the screen represents the 200 moving average. And I'd say not a bad spot, right? Because if we have a fair value gap here, and then we've got we have resistance right here, then why not? In my opinion, I'm not totally convinced just yet. I could, and again, this is literally just based on the behavior of the stochastic. Now you see how the stochastic just crossed just a moment ago. Like if you didn't catch that, just go back a couple seconds and look how the stochastic crossed, right? So this is kind of giving us a clue as to whether or not, in my opinion, we are at an extreme enough level, if we are exhausted enough on the upside to actually make a move down. And it looks like like we could get that move, but I would wait. And I'm gonna watch this, and I'll tell you if I would, in a live trade, make the decision to enter right here, or if I would wait for this level to get hit. Right now, as it stands, I would be waiting for my original level to get hit. But I'm watching. I'll chime in, and if I were, if in a live trade, if this was a decision that I would make, I'll tell you. We'll execute it just like it's a live trade. But as it stands right now, I will be holding out for my original premise. Now, the potential problem too with setting a limit order and just waiting for it to get hit, and just kind of rolling with your original premise without I guess remaining flexible enough to make a decision as to whether or not we want to hold out to see how the market behaves. I'll do some commentary on that too, because again, like the stochastic, the price action, it's gonna tell me if it looks appropriate to even hold the premise or not. So just let's continue to hang tight and let's watch it. So we're just short of hitting it. We're just barely short of hitting it. So these are those moments, right, in a live trade where you get really antsy and you want to just like get in. No, wait. Okay, so we just hit it. Okay, so what I like about what I'm seeing right here is when I look at the stochastic, right, I have this red line drawn across the stochastic to represent where the NASDAQ will typically see a reversal. So we've hit that level and we have a red candle, all right? So I have, right, presumably we had a limit order set right here, so we're already tapped into the trade. Now, if you wanted to market into the trade, you could, right? You can look at the behavior, make sure everything looks the way you want to see it look before you actually enter into the trade, whether it's a market order or a limit order, doesn't matter. So I like the way that it looks. Let's presume that I'm already in this trade, okay? So the only decision that I would be making is perhaps if I wanted to get out of the trade early because I don't like the way that something looks, right? So maybe I bail on the trade. As it stands right now, I don't want to bail on the trade. I think it looks good. I like where we're at. We're at an extreme level. I like the way the stochastic looks. We're getting closer to getting we're beyond the extreme level, and we see the stochastic looking like it wants to come down and cross, which is what I want to see. We have a doji candle right here, followed by a red candle. So far, so good. I like it. Okay, so the next thing that we're going to focus on is we want to see the next couple of candles, and we want to see how it plays out. And we want to Everyone has their own rules, but we want to kind of be mindful for, when and where we want when we want to initiate a break even stop, and where we would want that break even stop to be at exactly, right? Do we want it to be exactly break even? Do we want to trail it? In this case, what I would want to do is I would want to wait to see at least two consecutive red candles move in my directional bias, move in the direction of my directional bias, and I want to see them close, and neither one of them can be touching my entry point. So they've got to be moving away from my entry point down towards my take profit down here, and it's got to be two consecutive red candles that are neither one of them can touch my entry point. That's what I would wait for. That's just my personal rule. So far, I like the way everything looks, and I love the stochastic. I love the stochastic. I absolutely love the stochastic. This is the exact behavior that I would want to see on the stochastic. I want to see it cross after it hits that extreme level, and then I want to see it proceed to push down, okay? Now, the time that I do make an exception for placing a break-even stop early is when I see like really convincing movement, basically like good volatility moving in the direction that I want to see it go in, and it gives us just like a really nice big push. If I see just a really huge candle, I'll add a break-even stop sooner than later. In this case, I like the candle. It's fairly big. It's convincing, but I would give it time. And the reason why is because it's a big candle, but it's not a gigantic candle, and we do have these moving averages sitting right there. We have the 20, we have the 50, and the 200 all piled on top of each other. So even if this trade is going to go ultimately in my direction, and to my take profit, the likelihood of us not getting a bounce right here on these stacked moving averages, it's not very likely. It's not very realistic. So if we get the two candles that close, then I'll add the break-even stop. But in this case, I want to give it room to bounce, because it might want to go back up into the area. It's not uncommon, to see a fair value gap, be revisited more than once. So it's more common for that to happen than for us to see it hit that area, one time and then just glide in your favorable direction. So we're going to just outline the white box is going to represent our fair value gap, okay? Again, I like the way everything looks, and as you can see, we have follow the line of the cursor. So the line the line through the candle, that's one candle that has pushed in our favorable direction, which is red, and closed in our direction. Closed without touching our entry point. The second candle, however, is a green candle. So I'm gonna wait, right? Because I want two consecutive red candles that are not touching my entry point before I place a break-even stop. So we're gonna continue to watch and wait. We've got 30 seconds left on this 1 minute candle. And it looks like this one's going to close green unless something insane happens in the next 5 seconds. So we're going to wait. We're going to just continue to be patient. And we're going to wait for our 2 consecutive red candles that are not touching our entry point. So I would also point out, while we're waiting for this to play out, I would also point this out, right? When you see this happening, when you see displacement with the break of structure, fair value gap created on the way down, when you see that happen, if you can line this up with, order blocks, Fibonacci retracement levels, it's going to make it an even stronger move. In this case, we're looking at this trade and taking it just based on what we're looking at right here. I don't know where the higher time frame order blocks are. I don't know where the Fibonacci retracement levels are. This is literally just based off of the market structure of displacement with a break of structure and a fair value gap, and that's it. So this is, for me, this is a pretty naked chart, right? I do have my moving averages here. I do have a Bollinger Band on the screen as well, but this is the trade decision is it's solely based off of the market structure that we've been presented with, and nothing more. Okay, so now we've got 1 red candle that is closed in our favorable direction, 2 red candles, they're consecutive, they've closed, and they do not touch our entry point. So at this point, we would now have a break-even stop loss, okay? And I don't know what in the world happened over here where all of my tools disappeared. I've never done that before. I don't know how that happened. It's a little bothersome. 1 second, let me just play with this real quick. I don't know how how did it disappear? That's so weird. Whatever, it's gonna have to be fine. So just pretend in your mind, okay, that right below this entry point there is a break-even stop loss, okay? So we can't lose anything, okay? And if you look at the risk-reward ratio on this trade, it would be a 1 to a 3.71. So that's excellent risk-reward, and we're now in a free, protected trade. Life is sweet. It can't get any better than this, all right? And so now, at this point, while I wouldn't recommend it, you could damn near walk away from your computer and just let it play out, right? We have a break-even stop loss right here at our entry point, just below, so that we're not going to lose any money. And we've got our take profit set down here at our swing low, and that's it. We can just let it run and just let it play out. Another thing that I'll point out is some people may be thinking, well, why not have just taken this long right here? I don't think there would be anything wrong with taking that long if, right, whatever your entry criteria is, if it has met your entry criteria, I don't think there's anything wrong with taking that trade. What you wouldn't want to do is, have this premise of, oh, we've got displacement, break a structure, fair value gap. I know it's coming back here. I'm just going to ride this up. No, that you don't want to do. Because you don't know if it even hits the fair value gap. There's too many variables in that scenario. So unless an entry down here meets its own specific set of rules that you've already determined on your own, and this is a good trade for you to actually take independent of anything else, you would not want to do that. Don't do that. Okay, we want to stick to the exact rule set that we're looking for, and we want to enter at the right place, the right time. We don't want to do like these conditional, trade entries. It's not a good idea. It's a good way to get wrecked multiple times in the market on any given day. So I'm just going to point that out. Okay. All right. We're waiting. We're letting the trade play out. Oh, another question. Okay, so the question being, would we want to trail with our stop loss? The answer is no. The answer is no. You can, because you have to imagine, right? If we were in this trade with, let's say, an NQ, like an E-mini contract, this is already like a shit ton of money. If I had my goddamn, if I had my tools over here, I would measure it to show, where did the tools go? How does that even happen? Whatever. If I had the measuring stick, I'd measure it, and then we could see exactly, what that profit would be looking like already. But I would say, in my opinion though, no, you don't trail it, because when you start trailing your trades, if you trail this, you're not going to get a ratio of 1 to 3.71. You're just not. Like, you're going to have to be the ultimate, like, trailer. It's just you're creating a scenario where it's going to be very unlikely where your trade is going to be able to play out and finish. Right? So what we want to do is, especially when we have the opportunity to take a free trade where it's like, it looks great, we can put a break-even stop in, there's just no need to. Now, what I would say is this, is you don't need to exit your entire position right here, right? You can break this up. So you can scale out of the trade. So you could... depending on how you want to do, again, oh my God, like if I had my tool, I'm going to mess this video up because this is bothering me so much right now. I'm just like looking at this and I'm like, how did this happen? If I go here, so my tools are there. So is there like, there's some kind of drop down? Where is that drop down? Yeah, this is killing me. Oh my God. Yeah, bro, we don't have it, okay? I don't know. I'll have to figure it out after the trade concludes. But yeah, the point is, you can scale out of the trade. You don't need to hold out for this level here with your entire position size. So, you know, if I had my damn fib tool, I would show you what levels I would preferably get out of, I would scale out of the trade. But if we just took our candlesticks and we just looked at the market structure here, this is what I would say. I would say this swing low right here, this swing right here would be a good place to get rid of some size. Okay, so this level I think would be good. This level I think would be good. If you wanted to be, you know, extra conservative, you could throw another one somewhere here in the middle. But definitely I think this level would be good, this level would be good, and this level is great. So without having my fib tool, that's probably what I would say. And if I wanted to choose like a level in between here and here, I'd probably go for like where this swing runs right here. So I'd put another one about right here. Okay, so that's personally how I would do it. If I had a good amount of volume, you know, on my position, I'd probably, I like to typically scale out either really top heavy or really bottom heavy. So what I mean by that is at the very first take profit right here that I would set, I might get out of the position at like 50%, right? And then so let's imagine I have 4 contracts, right? So I'd cover 2 right here. Okay, so 50% of the position, I'd cover 1 here and 1 here. And so that way you are making absolute sure that you get out of this position with a good amount of profit, you know, and you're really protecting yourself by getting out of like 50% of the position here. But, you know, if you're super confident about a particular trade and you love your entry, you love where the take profit is, you love what market structure is looking like and what everything's doing great, then you could flip that. You could, let's say you have 4 contracts, you could get out with 1 contract right here, 1 contract right here, and then you could do 2 down here. So it's up to you how you want to do it. Another thing that I like to do is I like to, this is such a good trade. I wish I would have actually taken it, but what was I saying? Another thing that I like to do is, so let's say you want to go bottom heavy, but you want to protect your position. You could go 1 contract here, right? Imagining we still have 4, 1 here, right? 2 contracts here at the bottom. And when this take profit gets hit, right, you could bring your break-even stop down to this level here. Why is that a good level? Well, because we have a fractal right here. We have like a move down with a decent, you know, move up and then a move back down. So it's a little bit of what I would say is a little bit of a protected area in this particular trade. And it's above these moving averages here. So again, could be a good place to drag your stop to make sure that you're locking in profit. And then once we got this level hit, once we got out of, you know, how many ever limit orders we had here, then we could bring our break-even stop, that would be right here, and we would bring it down to this level right here. And so that way we would just make sure that if we do get a pullback, then all of our contracts at minimum would be out at this level here, okay? And then, oh, I'm thinking about food, I'm like hyper salivating. This is gonna be a weird video, but whatever, like you get the gist of everything. Yeah, and so then once we get this level hit, right, and we're moving down towards here, we could either place, you know, a stop at a level like a fractal that gets created along the way, or we could just, you know, once we get about halfway to this, you know, between here and our final TP, we could just bring our stop down to this level. So again, we're just protecting additional profit and making sure that if we do get a pullback and we don't make it to here, we would be locking in all of the profit from this point. Okay, so just some little tidbits. And when I'm in a trade and I'm looking to see, and when I'm like, okay, does it look like the trade is still going in my direction? Should I be worried? Are there any particular things that are occurring that would make me want to protect my position a little differently or a little bit earlier than what I initially projected? So again, I'm gonna say, like, I think it's best to just not interrupt the trade. But if you want to do that, especially if you're a newer trader, or if you're a trader who is trying to build that fortitude to be able to hold longer trades, this is what I would personally do. Is, again, I'm going to go back to, I'm going to look at market structure, but I'm going to look at my stochastic, right? So when we look at the stochastic, it hit an oversold level, right? So we see that we're down here in the oversold region. So when I see that, I know that if I also get other things happening, such as 2 consecutive green candles, after it's pushed outside of the Bollinger Band, this might be a move that could potentially go all the way back up to the fair value gap and either keep going or come back down again. And you might decide you don't want to ride all of that out, or you don't want to take that chance. So when you see your stochastic has become oversold, that's when you could really tighten up your stop and say, like, well, if it continues in my direction, cool, I'll continue to hold the trade. But if it doesn't, then I locked in my profits, and then we'll just call it quitsies on the trade. Personally, I don't really like to do that. I like to let the whole premise play out, because what typically will happen is, you drag your stop down, right? It gets hit, and then after this short pullback, the market just moves right back in the direction that you were originally planning for, and then hit your TP, but you just didn't get the profit. It doesn't always happen like that. Sometimes, the market does a pullback and then it's not a pullback and it just keeps going. But ultimately, I do like to err on the side of just holding the position. Well, I've done a lot of talking. Let's just continue to watch the trade and continue to let this play out. What did I just do? Oh my god. Okay, we gotta fix this. Hold on. Okay, yeah, sorry about that. I said I wasn't going to, but it's time for Uber Eats. You know what? Let me point this out too. So, okay, so with the stochastic specifically, do you see how fast the stochastic went from being, let's just open this up real quick. Do you see how fast it went from being oversold to overbought? When I see that, I pretty much know that I'm going to say, like, at least 8 times out of 10, this is not a move up, this is a pullback inside of a move down. Real moves are they're typically a little bit more patient. Even if you get huge candles, huge volatility, yeah, they're more patient than that. It doesn't, you don't go from being oversold to overbought that quickly. But so when you see that happening, the speed of that happening is an indication to me. And for me, I'm like, I'm cool. I'm gonna just stop is still here at break even, and I'm just gonna, continue to let it play out. And if anything, that's great, because now that we got this pullback, we're gonna reject off of this area. And this is a significant area because this is also, we have a fair value gap right here that's already been responded to. So when I see that, I feel really good about what I'm seeing in the market. And I would expect now that this move is probably going to drop pretty quickly. I could be wrong, but that's typically my thinking when I see that. And then on top of that, look how quickly it moved back up into being overbought, and look at the behavior of the stochastic, right? Of course, like, look, I know stochastic, the behavior of the stochastic is only representative of what the actual price action is doing, but for me, I like that visual, because sometimes looking at price action and looking at candlesticks can be tricky, and you think you're seeing something and you think something makes sense, and then something, the complete opposite of the premise that you developed ends up playing out in the market. But when you see the stochastic following suit, I mean, you don't really have to question it, because now you have the price action, you have the, like, what's playing out in the market, but now you have this visual tool that's it's measuring more than what you can see, right? Because you can have a particular premise and then something completely different happens, and the stochastic is it's going to give you clues along the way. Are indicators lagging? Yes. Are they just representative of what the price action is doing? Yes. But tell me that doesn't look clear to you. When you're in this trade and you're looking for a short to play out and for it to hit this level, right? And you see this pullback and you get antsy and you're worried and you're like, oh shit, the trade is pulling back on me. I think the trade's over. When I see the stochastic race, right back up to being overbought, and then I see a cross in the stochastic, and I see it rejecting off the moving averages, and I see the stochastic moving down in a uniform manner, it takes that anxiety away. I'm not really all that concerned, right? Even seeing this small candle do this little push up, that shit is nerve-wracking for newer traders. But look at the behavior of the stochastic. You see how it's pointed down? You see how it's open? It doesn't look like it's trying to cross back up. I feel really good about that. I feel calm in this situation, and I'm going to continue to just watch it. I'm going to leave my break-even stop. I'm going to leave my take profit exactly where it's at, and I'm going to continue to let the trade play out. And I'm going to move right over to the Selly and find something good to eat on Uber Eats here. And let's keep watching the stochastic too. Let's keep watching it, because you see how quickly it's moving from being overbought to being oversold again. It's happening very quickly. Okay, so we're gonna just pay attention to that. Just keep an eye on it. And do you see this line here right above this candle, right? It looks like it's a off gray, like a off-white grayish kind of color. But this represents the 9 moving average. And when I don't like to take trades, I don't like to take entries based off of the 9 moving average, but when I'm inside of a trade and in this particular situation, this is a short. So if I see, while I'm inside of a trade, the market rejecting off of the 9 moving average, that's beautiful. Like, because it could have pulled back to the 20, could have pulled back to the 50 or the 200, but the 9 is so, it's like the most bearish moving average that I have on my chart, at least. And when you see that, it's just an indication of a strong move, right? It didn't even touch the 9 moving average, in fact. So that's gorgeous. And look at the stochastic. We're entering into oversold region here with the stochastic. I'll make it bigger. Let's pull it up so that we can really look and see the details, see the beauty of the stochastic. How did that candle just freeze like that? What the? What the fuck? I know I'm not, okay. What the fuck is going on with my fucking screen here? Why is this screen being mad weird? Whoa. The fuck? Yeah, that was odd. Okay. Whatever. We're watching the stochastic. All right, look, and I look at meticulous stuff like this. Let me open this up real quick. Do you see how we're in? Now we're oversold, but do you see the behavior of the stochastic? Okay, look at this. I don't even have to really be, oh God, no, we don't want that. So what we want to see, right, now that we're oversold, we want to see the stochastic, we want to see it open up. If we get a cross, that's bad, right? It's not bad, but it's weakness for the direction that we're going in. So you see the way the stochastic is moving? Oh, I'm holding this all day. You see the rejection off of the 9? It's gorgeous. I mean, shit, we can't, what more can we ask for? Okay, and so also what we're going to look for, excusez-moi, what we're going to look for, right? We're not going to get jumpy when we see crosses happen in the stochastic, because the only reason we'd care is if we see a cross in the stochastic, but it actually, the candle closes and it holds. If that happens, then at that point, I'm going to be watching to see if we get 2 consecutive green candles, then I would protect the trade in that situation, because we've pushed outside of the Bollinger Band. We have like decent volume to the downside, but it's not huge. But I'm not going to worry just yet, because we need to wait and see how it plays out. We need the candles to close, and we need to see the way the stochastic looks after the candles close, okay? So we're still not going to be worried. And as of right now, we are cleanly rejecting off of the 9 moving average, okay? So I'm just pointing out the reasons why you don't need to panic in situations like this, and tools that I personally use to help me keep my shit together, okay? Watch the stochastic. Do you see that? Do you see the behavior? So the stochastic looks great. We're rejecting off of the 9 moving average. And Black Angus Steakhouse is looking really good right now. Okay, so this is a key moment. In this moment, I'm dragging my stop. Why? Because we have an aggressive cross here on the stochastic after it is, you know, pretty oversold, okay? And this could represent a point where the market wants to move back up. Okay, where would I put my stop? These would be the options here, okay? We could limit out of some of our position right here. We could place a stop above this fractal right here. I'm not really crazy about it though, because I know if we do get a pullback and then we move back down, I know that touching the 20 moving average is like very likely. The 50 moving average is highly probable as well. So without interrupting the trade too much, we can get rid of some of our position right here, and we can place a stop right above this level. Okay, so we would be protecting the trade while leaving room for the trade to move and do its thing, okay? Because we want to keep in mind that while the stochastic, it's an indicator and it does indicate certain things, right? It doesn't trump market structure, okay? But I would use it, okay, as a reason to protect the trade at a deeper level than a break-even stop once I see a move that pushes outside of the Bollinger Band, 2 consecutive green candles, and the stochastic being oversold and crossed and looking like it's ready to go up, okay? We can also see in the MACD, we can see weakness developing in the MACD. So the darker the lines are, or the bars are, in the MACD, the more bearish we are, and when we see them start to turn white or get lighter, it's showing weakness. But again, just remember, this is like, we're looking at 1 minute candles. This is a very small moment in the market, okay? So we're going to protect, but we're not going to interrupt. Protect, don't disrupt, okay? So stop would be up here, and we're going to leave the trade to be able to run. And like I said, we could have gotten rid of some of our position right here just in case the trade did turn around on us. But the rest of our position size, we will leave it on and we'll allow it to continue to, you know, have a chance to run into our take profit. I like the rejection off of the 20 moving average, this light blue line right here. That looks good. I like it. I'm liking it. And so just because we have a move up to the 20 moving average and it looks like it's rejecting, it doesn't mean that it doesn't pull back to the white line here, which is the 50 moving average, right? But that's why our stop is up here and we're leaving room for this to continue. Okay, so again, if you're massively uncomfortable with that, you just reduce your position size here. Get out of some of your position, lock profit in, put your stop here for the rest of the position, and give it a chance to continue running down into your take profit. Oh my God, I've had steak like 4 of the last 7 days. I don't know if I should eat steak again. And then let me just bring this back so that we're able to see everything that the stochastic is doing down there. So far, we haven't been able to get above the 20 moving average. I like it, I like it. Steak or fish? These are serious decisions which must be made here. How many ticks is this? Oh, this is only 156. That's not bad though for a trade that was identified and entered in the 1 minute time frame. Okay, so once again, I'm just going to point out the stochastic looks exactly like what the price action is showing us. Small pullback, and then got kind of like a cross there on the stochastic. You don't need to panic. You already locked in some profit, and you have your stop pulled down. We're okay. We're good. Just relax. So far, so good. We've rejected off the 20. We've moved below the 9 moving average. Body is sitting below the 9 on this candle. Stochastic looks great. And we can see on the MACD, we had this pullback right here, right? And we can see that we were green, turned white. So losing momentum to the upside, flipping back to the downside. It you know, it's kind of saying the same thing that the price action is saying and the stochastic is saying. But again, like for some of us, these visuals are just, they're helpful. They're calming, reassuring, right? And I want to say too, looks like our entry on this was about 2648. And if I go over real quick, let's look at the 15-minute chart. So I mapped out this range. This is the top of the range. This was the bottom of the range. So you can see we broke out of that range, and then we've pulled right back into it. So if we were going to be anything, we would want to be short around this area anyway. And if we were down here somewhere, we'd probably want to get long. Of course, it still depends on, you know, our rules being met and some other factors. But I like where it's at for being in a short. And then I would say if we can get a push below this swing right here, this level, so if we can get a drop down below here, I think if we're dragging the stop, right, because of, you know, where the extremes, or because we have hit an extreme on the low end, and we don't want to you know, potentially eat all of a potential pullback. I would say that if we get down here, this level then becomes a really good, a nice spot to put our stop loss at. And so let's also just like focus on a few things here too. Like let's look at this, right? So there's a lot of people out there who take trades where they're just looking for, you know, could be like 10 ticks, 15, 20. We're far beyond that in this trade. We're like, we got deep into it, right? So if you did take profit here and leave your remaining position with a stop up here, you already still had a hell of a trade. True or false? Did you not? You did. You did. And we're still coming back down here. Okay, just keep it in mind. But if you were someone who, you know, trailed with a conservative stop and you got stopped out, you still had a good trade. Your risk reward still made a ton of sense. Okay. Right? Like it would still be a good trade. Still would be a good trade. And even if you got rid of some of your position right here and you had a stop for the remaining position size and it got hit right here, still a good trade. But if you can hold and just let it run, you will typically be very happy with the overall performance by the end of the week, the way everything plays out. Even if you take some losses, even if you get some trades that, you know, the moves aren't as big as you wanted them to be or whatever the case may be, if you trust your strategy and you let it play out, end of the week, end of the month, you're going to be happy, you're going to be satisfied with your results, and you will have an account that has grown. So you don't need to worry about freaking out in every single trade, and it's okay if you don't get every single, tick that you initially wanted to get. Keep in mind, this is a risk reward of 1 to 3.71. It's damn near 1 to 4. And let's look at this level right here. This level right here is just shy of a 1 to 3. So it's like it's a 1 to 2.83. Yeah, still good. I'd still be happy with it. All right, but we're going to put that back and we're going to continue. We're going to continue to watch it, and we're just going to think of this like as if we had a break-even stop. Or I'm sorry, a stop here, and we reduced position size around here. Okay, I gotta order food. Oh my god, this chicken sandwich looks wild. And you know what I would really want to hold, like another reason too I would continue to hold this trade is because we have the correct market structure, and we don't have a true volume exhaustion to the downside. So like you see how over here, right, in this area, how we got this nice move down, and then we got this gigantic red volume bar before we reversed back up to the top. That's what I would ideally want to see before trying to even thinking about getting out of the trade. So in this case, right, let's say our stop was here, so our stop has been hit. So in this case, we would be out of the trade. If you left your stop at break even, you'd still be in the trade. Of course, you definitely run the risk of this just coming back and wiping you clearly out. But in a real life scenario, I would have gotten rid of some of the position right there, and I would have had a stop right there. So I would be out of this trade. But we'll continue to watch it, and we'll see how it continues to perform. Revisiting the fair value gap, tapping back in that. I can't focus. I can't focus on the Uber Eats. I'm like, back into this trade, like my money is actually on the line. Okay, Kneader's Bakery and Cafe. They're so good. Oh my god, we're right around the corner from market close. It's actually really important. I wasn't paying attention to the actual time. I will say this, usually I wouldn't be in a trade this late, but so it ran the entry point at this point. So usually there's two really key times that I would like not trust a trade to play out properly, and that's between, I'm gonna say like, we're gonna say 11:59 Eastern time all the way to about 1:10 Eastern time, and definitely like at the end of the day. So like 3:30 at the latest, you can so you should expect some kind of crazy move to happen around 3:30 to 4. But if you're like, okay, so for example, like we kind of saw this building momentum down here when we got this move here. And the only thing that I would say any different than anything I've already said is that based on the time of day, yeah, you probably would have at 5:30 started to protect this trade really tightly. Just because explosive moves happen at 3:30, and I know a lot of people don't like indicators, but look, extreme levels are extreme levels and the market responds to them. So 3:30 is right here where that line is. So that would have been a good time to just kind of probably trail super tight, just only because of the time of day. If it were any other time of day, I would say I would do exactly as I mentioned. But again, at the end of the day, really good trade. I like it. And even for like the time of day, like the time that we entered and the time of day right now, that was pretty solid. So I think it was good. And hopefully this video has provided some value for you. Hopefully I've given you, if you haven't thought about some of these things, hopefully I've given you some ideas about how you could trail, how you could protect a trade, certain things that you could look at to give you, extra reassurance in a trade, just aside from, the price action itself and the market structure. And yeah, so I think that if we were actually in that trade, I think we would have made a good amount of money. It would have been a good trade. I would have been happy with it. So yeah, that's that. I hope that was helpful, but just know that this is ICT, right? Not to a T, but this is what he teaches, right? Displacement, break of structure with a fair value gap, and boom. I added some extra little tidbits that I like to use personally, like the exact level that I like to get in the trade at, the fair value gap, how I like to get in between the 62 and 78% level. I'm sure I mentioned some other things that he doesn't necessarily teach. So anyway, so that's going to be that. I am going to I'm going to let this continue to go, and I'm going to let the video run, because I'm sure there's someone who wants to see, like, well, what if you never moved your stop into break even at all? And what if you just let the trade run? What would have happened? So we'll just let it run, and so that we can answer the question for anyone who's wondering that specifically. But yeah, I hope this has been valuable for you. The whole displacement break of structure with the fair value gap, it plays out in the market literally every single day. Like, that's not an exaggeration, every single day. So if you can couple it with other things, those things being order blocks, Fibonacci retracement levels, moving averages, areas where you've seen repeated rejection or support, whatever. Of course, it's going to only make the technique even stronger. But yeah, so I'm just going to let it run until it hits what would have been the original stop loss, and then we'll close the video out. Okay, and there we go. All right, until next time, guys.